Financial crisis in emerging markets. So we're going to learn about two interesting crises. Number one, we're going to learn about South Korea, 1997-98, and we're going to learn about Argentina in 2001, 2002, as to how these two emerging markets went through financial crisis. So financial crisis typically starts with either a deterioration in financial institutes like banks, NBFCs, any financial institutes. If they have a problem, that's the major source of starting of any financial crisis. The other source of starting a financial crisis is the government has a fiscal imbalance, or they are spending more than the taxes revenue that they are collecting. So let's look at what happens. Why does a financial institute like a big bank fail, right? So the reason why it fails typically is because of lending boom, right? When you borrow, when you as a bank lend money to weak creditors. So why does that happen? So let's look at that. So typically deterioration happens due to credit boom, and credit boom, which is basically lending to weaker players, is credit boom, and that happens because there is financial liberalization. So financial liberalization is basically saying, I'm going to open up my banks to foreign money. I'm going to open up my economy to investors from outside, and that is a good thing, but it can be very disastrous for economies that are emerging, and we're going to look at why. So let's say credit boom happens because there's financial liberalization. Let's assume that there is for some reason financial liberalization, but there could be one reason, could be a political influence. There could be certain rich political parties, or certain big organizations who really need more access to capital. And there could be genuine players and there could be Ponzi players. So political influence or political agenda or business organizations require changes to the institutions, to the economy as how it works. So it will have an influence on the government regulations. So government regulations, when it's opened up, it can have a credit boom. More people will get money. Those credit boom can be riskier investments because there's a lot of greed. These banks want to lend more and more money because they can make more and more profit, right? So when this cycle happens because of some political influence, some business influence, and that could happen for a good reason, but it could also happen for a bad reason. And that political influence can also weaken the regulation. They could say, hey, the regulation might come in and say you can only borrow up to 50% short term, 50% long term, but they could go in and make it a little bit more relaxed. They can say, hey, you can borrow 80% short term, right? So when you have lack of free press, which doesn't clearly say what the issues are with this political or business parties that are doing the wrong thing, then you can have financial liberalization could be used for the bad thing, right? Where you credit boom happens, riskier investments get made, and because there is lack of free press or because there's lack of good resources to supervise this riskier investments, primarily because of in emerging markets you have lack of great tools and skill sets to have the right screening for risk monitoring, screening for assessment, to make sure that the right people are given credit. So that could happen because there's not enough, even if there is a clarity in terms of who is riskier, who is not. But if you cannot legally enforce, if you cannot legally stop a company to go into bankruptcy because they cannot really give you your money back, there could be many reasons that the emerging market has. The first one being lack of law enforcement, less resources, less screening, less skill sets, lack of free press. So when you combine all of this, the financial liberalization can actually become a curse instead of a boon. Why? Because there could be credit boom, and that boom may not be for good players, it could be for riskier investments. And so when all of this happens, and this typically happens more in the emerging markets because they lack all of these things, then the financial institutes, they suffer because they would have developed weak credit culture of lending money to weak creditors. And so what happens is people quickly realize. So they will have, these banks will have limited ability to raise money locally. And so for what do? They will then, due to this financial liberalization, they would start borrowing money from outside, foreign money. So more and more foreign money would come in. And if more and more of that foreign money comes in as a short term, then they can go out quickly as a short term as well. So what happens is, during good times, all of these stimulations work, more people get money, borrowing happens from foreigners, foreign money comes in. And so you see there's this big cycle, long period of weak lending. And so when this happens, automatically banks' balance sheet would degrade. Their profitability would go down, their assets would go down. And when that happens, right? When this happens, this is when you will see like one or two banks go to bankruptcy. They'll like, hey, we cannot really meet all of our debtors. And so what they do is, before they go to bankruptcy, banks would cut lending. That's the first sign. When you see banks cut lending, that means they're risk averse, or they cannot really do their business well. And so when they cut lending, more and more players come into the market who it's very difficult to assess risk, because banks are the only major source of assessing the risk of a creditor. And so adverse selection increases, moral hazard increases. We've covered all of these topics in the previous videos. But in a sense, basically those people who come to you for money in this stage are the most riskiest people. And so adverse selection happens, banks end up giving more and more money to those people. They actually want to cut back, because they're like, hey, the people who are coming now are the most riskiest people, so I would not want to give them money. And due to this, what happens is, when they cut lending, economic activity declines, right? So because less people have access to credit. So what happens here? The aggregate demand curve goes down, right? It goes up into the left, right? So the aggregate demand goes down. So when aggregate demand goes down, some of these weak players will go into bankruptcy. They got like, hey, we already had a thin margin. Now all of a sudden my demand vanished from my customers, so they'll go to bankruptcy. So when those customers go to bankruptcy, they cannot give back the money to their banks, and already those banks have weak balance sheets. It's one of those weakest player will fail. When one of those weakest player fails, one of those weakest bank fails, that'll have a pressure on the related bank. So basically these banks borrow from each other. When one of these banks fail, the bank that it borrowed from will now be under pressure. So the second closest, weakest link will start to feel the pressure. And so their balance sheet goes down. And as you see, this is a vicious circle. If one bank fails, people run for the bank. Banks actually have a vicious cycle here, right? So more and more banks fail. So when more and more banks fail, you continue to see economic activity decline, GDP goes down, unemployment goes up, inflation goes up, unemployment rate goes up. I just correct this one. Inflation goes up, right? And so a lot of people are out of work. And so this causes a lot of cost to human capital. You see suicide increasing, more and more people go from middle class to poverty, drugs usage goes up, crime rate goes up. So there's a huge cost at play when the GDP goes down or economic activity goes down. So now this trigger, right? This is one trigger. We saw how the banks actually collapses, right? It starts with the bank's crisis, but then when one of the banks collapses, right? People who trade currencies, they notice. They're like, hey, this country is having issues with this bank. So then what they do is they start to do speculative currency attacks. What they do by that is they start to short sell a country's currency, meaning they sell that currency and buy dollars, let's say. And when that happens, bond prices go up because there's not enough value for that currency. So when that happens, currency loses its value, right? Because there's more of that currency. And when that currency goes up, bond prices, bond yield goes up, bond prices goes down, right? And so when this happens, because there's more and more of that currency in the market, no one wants that local currency. And so when the currency goes down, meaning there's a devaluation of the currency, now if the country has money in the dollar denominated debt, now all of a sudden they have to pay more because their currency has actually gone down. If it was $1 to 1 rupee, now it's $1 to 50.5 rupee, right? So it's now like 50% more, so you have to pay double. So your balance sheet further degrades. So when you now have attacks from currency speculators, your balance sheet further goes south because your debt, currently the same debt, went up because of currency losing its value. So typically when this happens, central banks come in and then they raise interest rates. And so when you raise interest rates, bond yield goes up, bond prices goes, bond prices goes up, bond yield goes down, right? And so they're able to nullify this, but there is only limited foreign reserves. So when the speculators are able to spend more and speculate much more than the central banks in the emerging market, then they will suddenly lose power. At some point, they'll have to give up because then they do not have the dollar equivalent to buy back their currencies, and so they are not able to use their foreign reserves. But then when they raise interest rates, that actually has a double punch to the banks, because now banks will have to borrow at a higher rate as well. So that is a problem. And so when bond prices goes up or interest rate goes up, when bond yield goes up, when bond yield, in this case, it go up and go down, right? So when bond yield goes up, stock market falls because there is a safer investment. In a bond, you can get higher percentage return. So stock market falls. When stock market falls, the wealth of the people decline because they've invested in stocks. And so when wealth of the people decline, again, there's a huge connection here to the bank debt, because the bank has loaned to these wealthier people. Now all of a sudden they have less wealth, so they'll go into moral hazard, meaning they'll take more risk because they have less to lose. So when they take more risk, the bank has worse balance sheet, and then that has another cycle. So you see, there's a vicious cycle here that is forming. And so bank balance sheet degradation, currency speculation are the two main reasons where this cycle can get worse. And when there's a fiscal imbalance, what happens when there's a fiscal imbalance? The government somehow has to figure out how to raise money. What they do typically is they force banks to buy their own government bonds. And so when they do that, banks now are in the same situation of lending to the poor credit-worthy country, its own country. And so it's the same cycle happens, right? So in this situation, we've not even discussed like the negative supply shock, like oil prices going up, commodities prices going down, or interest rate in US going up, which is a safer investment, and all of this money will dry up from here. When that happens, there's a more pressure here as well. Typically, in the emerging markets, the banks play a huge role, but like in developed markets, there are multiple other ways to raise money through the securities market, the stock market, the bond market. The NBFCs are big, but in the emerging markets, the banks play a huge role given the proportionate size that they have, right? So we've not even factored in the negative supply shocks, and that could make this whole thing really bad. So in case of Argentina, let's look at that. Argentina happened in 2001, 2002, when their financial crisis typically started with this government fiscal imbalance problem. They didn't have any financial institution problem. Actually, they had the best of the banks. Their banks were really well run. They didn't have any balance sheet issues. They were actually really solid here. But then the way the central government and then the provinces or the states work in Argentina had a huge issue. The states were responsible for all the spending, and the federal government, the central government, was responsible for raising all the taxes. And so the government had very hard time collecting the taxes or raising taxes, and so there was a fiscal imbalance. So due to the fiscal imbalance, they were not able to raise money, and now they were able to only raise money by forcing the bank to buy their bonds. So they made their banks worse off because they made them to buy their bonds because they couldn't raise money locally. No one was willing to buy their bonds, government bonds, to service their expenses. So Argentina followed this route of getting into the cycle. The fiscal imbalance is what got them to this cycle. So one of the banks first collapsed, and then people got into speculative attacks for Argentina currency. And so then there was a currency crisis, and then there was bank failures, and there was a full meltdown after that, right? So Argentina started this way. South Korea in 1997, 98 started with this issue, and they had this whole thing going on. They had large business organizations, family-owned organizations that had a huge control over entire GDP. So like more than 50% of them were controlled by these too big to fail organizations. They had a huge political influence. They got to financial liberalization. They relaxed the regulation much more, to the extent that they had more short-term inflows coming in than long-term inflows. And so what then happened is credit boom to those families happened. They borrowed as much as they could, and so then when one of them failed because of a negative supply shock, this whole thing collapsed, meaning more and more of those family organizations failed. The government really couldn't even raise interest rate, because then the banks would fail even faster. So for them, it started with deterioration of their banks. The banks started collapsing. And then currency, people saw that currency speculation started happening, and currency speculative attacks started happening. And so when those two started happening, there was this whole entire system under full crisis mode. So similar things also happen in advanced economies, and so this doesn't mean that this is only related to emerging markets, although in emerging markets, these financial institutions play a huge role. They have a very weak central bank that's not really independent. They have very limited foreign reserves, so they can't really have the firepower to fight these attacks. Their inflation targeting also is not as well developed. So when that happens, they are really susceptible to all of these attacks. And so what's the solution to this? The solution to this is prudent regulation, meaning you first sequentially do all of this. Financial liberalization has to happen, but it has to happen in a sequence. The first thing is you need more disclosures, you need more supervision, you need the right people. So you need right enforcement, you need a free press that actually can throw light to these worst practices. You need sufficient resources, independent organizations to monitor. So you need the foundations right, and you need the political influence to be out. And the way you do that is through disclosures. You have to make your banks disclose what they're doing, who they're lending to, how much they're lending, are they profitable, are they not, and why they're not profitable. So you do that, and then you make your banks really hold enough capital. So you increase capital adequacy ratios. You have incentives for these banks to loan in local currency, and then you limit currency mismatch, wherein your loans outstanding are denominated in foreign currencies, which can further have issues when your debt suddenly goes up because of currency fluctuations, right? You have a central bank that is actually well capitalized. You have enough reserve, and you have enough staff to enforce all of this. And so you need to do this in a sequence. If you open it up very quickly, then there's a lot of greed that can come in. There's a lot of issues with speculative players, short sellers, that can actually make this situation worse. And then the overall impact to the country is long term. Even though there would be self-correction after all of this failure has gone all the way down, you could see stock markets go down more than 50%, currency go down more than 50%, inflation go up 40% year on year, like huge. You would see GDP decline crazy, right? So it is a huge long-term loss in terms of opportunity loss. So understanding emerging markets as to what happened in the past to these countries, what's the best way to get to financial independence and globalization is very important. So hopefully all of these concepts help us understand how macro situation is helping us better understand how these financial crises develop and how we can avoid them. Because in reality, it's the simple aggregate demand supply curve. What happens when your aggregate supply goes down and your aggregate demand goes down, right? Your output goes down and inflation goes up, right? So typically when your aggregate supply, when an aggregate demand goes down is when there's lots of financial friction, right? We saw here the demand goes down. So when the demand goes down, you will see overall output going down, inflation going up. And when aggregate supply goes up, because let's say there's negative oil shock, interest rate goes up, US interest rate goes up, and so oil prices goes up, and so then what you would see is the same situation. Output falls, inflation goes up, and so really understanding this, taking the right steps is very important for emerging markets. Hope that was useful. Thanks.